Nifty has closed above 6,000 for second day on the trot. Telecom stocks were up and they were up on strong volumes. TCS, they came out with a strong set of numbers. The stock started well in the green, but it's turning out to be more like a buy on rumors and sell on news story for TCS, which corrected and closed in the red after a strong set of numbers. There was late surge in cement stocks. Axis Bank numbers were impressive. The company has managed to report a strong expansion when it comes to the NIMs as well. The top traded counter on National Stock Exchange was Unitech. Bharti was the biggest gainer on the Sensex. Telecom stocks across the board, they were on a tear today. Bharti, Idea and Arcom. Cement stocks, ACC, Ambuja, Ultratech, all the big cement stocks, they had a strong session. Banking as a group was mixed. Private banks on a relative basis, they had a decent day. OMCs, again, a mixed trend for OMCs. BPCL moved up on strong volumes, HPCL was flat, and IOC saw some renewed buying interest in the last 1 hour of trade. Money clearly seems to be moving out of defensives. Colgate, United Spirits, and Godrej Consumer, the performers of 2012, are now coming under pressure. So what's the way forward for Indian markets from these levels? Let's discuss that with Samir, Ashwini and Funny. Gentlemen, good evening to all of you. Thank you for joining us. Ashwini, if I map today's market action, things were choppy. Benchmark indices, they moved both back and forth, but the net outcome was very impressive.
Well, on a point-to-point basis, you went up 25-30 points. But, if on the Nifty you have to take a risk of 100 points and you are, confined to making 25 points a day, then, if you are putting real money to work, it's not worthwhile. Because just one day, one bad news and, 4 days worth of profits get taken out. Obviously, markets fall faster than they rise. So on a Nifty basis, yes, we are limping upwards. But on a 1:1 kind of market breadth, on leading stocks not really doing whole lot, cement, ITC, these sort of stocks make some sort of a comeback, maybe an odd telecom. So it's difficult to see where the incremental buying will come from. And even if you have 100 points upside, I mean it's no point risking 100 on the downside to make those 100 points. So I think there are much better individual stocks that can be bought instead of trying to go for the index.
Funny, what is your understanding, risk versus reward? How are things stacked up according to you?
Well, I would agree with Ashwini that now the risk reward is more like 1:1. Because if you look at the major components of the market, you have IT, oil and gas, consumers and banking, which might take the leadership for the Nifty to go and touch the previous highs of around 6,300. But of all these sectors, it is really difficult for us to imagine that anyone can sustain at those levels, because IT 5 or 6% from here will be looking, at least in the near term, ahead of its fundamentals. Oil and gas leadership is predicated more on news flow and on what kind of reform measures the government announces. Even if some sort of deregulation is introduced, the oil price is always a joker in the pack. FMCG valuations are clearly out of whack, and volume growth has been slowing for some time, although in December they have been able to increase prices to offset the volume growth. So all in all, you are seeing that the outlook for many of these sectors is not exactly very upbeat for them to surge ahead by 5 to 10% and stay out there. What might very well happen is the base of the market might have shifted up from 5,500 to maybe 5,800 odd levels, and the market might very well go and touch 6,300. But it's a very good possibility that over the medium term, you will see the market oscillate between 5,800 to 6,300. So for investors, it's not such a bad place to be in, because you will have very divergent performances from individual stocks, and it's a good opportunity to pick stocks.
Samir, you are a big fan of the entire private banking space. You like HDFC Bank, you also like IndusInd Bank, and you also like Axis Bank.
Well, we own even more. We own Yes Bank, we own ING Vysya, we own all of them. The thing is that we, in our portfolio, why we don't get blown up, and now in our hedge fund we have to be even more careful than before, is that you don't want the highest possible return in every stock in your portfolio. So we have basically two categories of stocks. One is high confidence in reasonable return. That means it should do well, it should not pain you if the market falls, it should not fall apart, it should not lead into scandals, and generally you feel that it will do well and compound well. And some 60-70% of our portfolio will be in that category. The other is so this was high confidence in reasonable return, and the other is reasonable confidence in high return. Sometimes that confidence does not yield fruit in some sense, like you may say currently in Arshia. But in general, we find that, we have had many multi-baggers. None of them you could have said high confidence in high return. Nowadays, I see so much conversation on all these stocks saying we should not buy leverage stocks, we should not buy reverse listing stocks, we should not buy stocks in infra. None of them would have worked, because there are hundreds of examples in each category where the best stocks that later on turned out to be so obvious initially had these problems. I read somewhere somebody said we should not buy reverse listing. Well, currently the McDonald's North and West, I think, or whatever that franchise is basically got reverse listed. If it was available tomorrow, I would buy it. So the thing is, there are no rules, but therefore in these reasonable confidence in high returns, because the confidence can at best be defined as only reasonable, even if you actually may feel that this is a real multi-bagger, but it will have some problem on that first day when you buy it, to not get super confident about it, and therefore you should have maybe 2%, 2.5% if best in any of these names, and then hope that some of them work and some of them will invariably not work. But they should not embarrass you like this one seems to have embarrassed me right now. But let's see how it develops.
Yesterday was a good day for PSU banks. Today, in general, was a good day for private banks.
I think of banking as looking fine when, Bank Nifty is making 200-300 point moves. The Bank Nifty hardly moved up 100 points. HDFC Twins did nothing. An odd Axis Bank moved up. Maybe a Yes Bank moved up. So the performances even in banking, within banking, are disparate. Earlier, PSU, private, both used to move together. And that's the whole point, that we have gotten to such levels that now we are, nitpicking even within private banks, that you should buy X private bank and not buy Y private bank. So then, it becomes very difficult to say, had you bought, say, HDFC today, you made nothing. But if you bought Yes Bank, you made something. If you bought Kotak Mahindra, probably again you did nothing. So, at these levels, stock specific performance is coming in more than, certain sectors moving together.
Funny, what are expectations from Bajaj Auto? Do you think this time around they could disappoint or surprise analysts?
I guess they are likely to surprise the street on the upside, because they had a wonderful month just before Diwali. Apart from that, exports and more importantly, the three-wheelers started doing well for them. But having said that, I don't see how the results that they're going to post is going to move the needle much, because Bajaj, if you remember, was already trading at around 17 times. So the street was already factoring in good performance for this quarter, and more importantly for the March quarter as well, better than at least what the company had guided before. The more important point will be what is the company's outlook, at least for the current quarter, and although they are unlikely to bind themselves to a guidance for the next financial year, but still the competitive intensity is something that the street will be looking at very closely. Because while the entire two-wheeler space looked very attractive maybe 4 to 5 months back, both Hero and Bajaj, but the recent run-up has made up for much of the underperformance, and from now on it's going to be the real earnings growth that's likely to lead to the next set of rallies, and that seems a little unlikely from the current valuations. So at this point in time, I think it's a good idea for investors to sit back, relax, and wait for more corrections in these two stocks.
Ashwini, do you think Bharti is looking good for another 10-15 rupees from these levels? Because it's been a vertical recovery for that stock.
Well, it's done. It's consolidating. You can't say that it's been vertical. A lot of people remember 300 and 330, how much time it has spent. So definitely the stock has done its hard work, and finally maybe some news flow is turning. So chances are that Bharti for the moment is bottoming out, and this 250 to about 450 range that has held on for a long time, maybe the upper end of the range should come in times to come. The next target, however, is about 380, but we should remember it's no longer a growth stock, and people who entered at the abyss of about 250, now slowly as the stock moves higher, should scale out of the stock rather than taking fresh entries at this point, unless you're a short-term trader.
Samir, this question is coming your way. What are your thoughts on IT, IT stocks? Do you think large cap IT stocks they have hit the abyss, and 2013 could be a solid year for large cap IT companies?
I think they could, because one reason is that last year they clearly underperformed, and part of it was to do with the fact that Infosys was sort of standing out, and therefore even if you were bullish on the other companies, you felt that how can it be that Infosys is doing so badly in the same environment. Actually, we ourselves are actually right now underweight tech, or we were underweight and we still are. And so in some sense, we also one day, but not right now, will maybe have to reluctantly add a little bit more. But in general, because the US corporate sector is very strong, and the US financials companies are quite strong. If you just look at their stock performance, all these financials were up as much as 100%. Bank of America was up, and Citi was up some 60%, and generally the whole industry. And so therefore, from a big picture sense, there's a catching up to do for the sector when you look at last year. And because Infosys has definitely sort of put a floor on its own share price, I think the IT sector will do well. Now, whether it does better than all the other sectors, I don't know, but in general, it will be satisfactory performance at least.